All right. Hello, everybody. Welcome back to the channel. I have the honor and privilege to be sitting here today with the man, the myth, the legend, Mr. Tom Lee. Tom, thanks for taking the time.
Yeah, thanks for having me.
So I want to get started just by giving you your flowers, because I think in this day and age, it's very quick to kind of be fast with the media and not recognize that there are people that need to be acknowledged in terms of what they're doing, especially in a niche like finance. Back in 2022, 2023, you were one of the only people against the mainstream media establishment that said, I don't think this is going down any lower. I think we've bottomed, and I think this is the beginning of a new bull market. And because of that counter opinion to the rest of the world, people like myself and millions of people across the world that listened to your advice, that actually tried to understand the research you were presenting, which a lot of it was not backed up by conspiracy theories, but was backed up by facts and data, have changed their entire financial lives. And so a big thank you from me, a big thank you from a lot of people that I know that are watching. My first question is, what does that make you feel like, knowing that you are literally the voice of a generation that has been able to fundamentally change their financial future because they listened to every word coming out of your mouth?
Mm. Well, thank you. Thank you for the compliment. I do really appreciate it. That's what we were trying to do when we created Fundstrat. When we started the company in 2014, 11 years ago, and I'd spent a career at large banks, almost 16 years at JP Morgan as chief strategist. I wanted to create a company that was targeted to bring institutional grade research, but make it understandable for everybody. And the bet at the time was that in 2014, the public wasn't interested in stocks. Trading was dominated by institutional.
Right.
Retail trading volumes were dropping. But we said, you know what? I remembered in the 90s when people cared about stocks. I think that period's going to come back. So our bet was that people would have interest in what we had to say.
And what at that moment, because that's a hell of an argument to predict the Robinhood generation before that happened. Was there data at the time?
Well, actually, yes. So part of our evidence-based research is that we look at demographics. And so we've written many white papers about how things happen by generation. And what we had published, and actually we published this as a white paper, was that the millennials were the single largest ever generation. The total cohort size is 98 million births.
Right.
And that was 40% larger than the generation prior.
Right.
And what happens if you look at by generation, you split to 20 years, every other generation cares about stocks because the one that's previous gets wiped out.
Correct.
So the dot-com bubble burst, GFC. So a lot of my peers were like, forget about stocks.
Right.
But then someone who started making money after 2009 was like, stocks are great.
Yeah.
So we were betting that would happen. In fact, when I was at JP Morgan, in our managing, our partner offsites, I actually suggested, why don't we get into retail brokerage?
Right.
And they would kind of be like, it's a dead business. Like, why?
Right.
But of course, now you can see that would have been a good tactical investment to make. So that was our bet. And we were small because, we're not supported by a big platform. So we also had to learn how to connect with people and, sort of amplify our voice. And so we used Twitter very early and the media as well, to appear on the media networks. And so that was our guerrilla approach to kind of growing our presence as a company.
Embracing new media at the time also was a bit risky because social media was not like it is today back in 2014. Did that feel natural, or did that feel like this is a struggle to figure out how to communicate to the rest of the world?
Well, the first couple of years, I would say it was a little hard to find our voice. Twitter was 255 character max, and it wasn't as robust, so it was just almost pure text. So it'd be like, well, what do you say in 255 characters?
Right.
And people weren't threading back then, one of and use a threader image. So we just ended up realizing, it's better to speak like we're just talking to somebody.
Right.
And so we would just sort of put out little tweets.
And I think that natural authenticity is what we get as an audience when you're on CNBC or when you do, independent podcasts like this. You've done a lot of independent media. The weight of your words really does matter. And when you've established yourself as a financial brand and when you've gotten the types of calls that you've gotten right, people really listen to the next thing that you're bullish on, bearish on, interested in. Does that feel weird every time you say something that literally millions of people will have an opinion on what you say?
Yeah. I mean, it's a big responsibility. I've been an equity research analyst for 34 years. And I used to put buy recommendations on stocks. And so I understand that feeling of like, okay, I put my name, I put a price target, and then everyone's going to get upset if the stock goes down. And as you know, in the public domain, we're always judged by the success of our last call. So
Correct.
and then Twitter, there's people who never forget. So like, I would say the majority of our conversations on Twitter are people like yelling at us and screaming at us and saying how bad we are. And I think it's kind of funny. So I don't mind because I know it's just the nature of the platform, right?
Right. Well, you do a good job quote tweeting their tweets on the days where, you're not really that wrong, which is more often than when you are wrong. And I think, that does a good service to kind of communicate your message to the world. Okay, so let's get into some stuff around the markets that I think people will be interested in. Here's a tough one, or here's an easy one. Not tough at all, no pressure. Should Powell be cutting rates?
As you know, I actually almost never comment on it, like my opinion on it. In fact, in our writings to our clients, because we have about 10,000 RIA clients and 300 hedge funds, but I do show them evidence and then say like, well, what do you think, right?
Right.
And so if I did that, like sort of say, here's how the Fed's supposed to be and what they're supposed to look at, then what seems appropriate? For instance, we know that core inflation is probably really at 2, using the measurement that the ECB uses.
Correct.
Because the ECB excludes shelter.
Right.
So just by excluding housing from the US CPI, core CPI calculation, inflation's 1.9.
Yeah.
And so the ECB's at 2.5%, Fed's at 4.5. So why, if just conceptually, the Fed's 200 basis points tighter than the ECB, but the difference is because of housing.
Correct.
So is the Fed trying to destroy the housing market, And they're not.
It'll definitely make you wonder, though.
Yes, so that would make me wonder. The second would be, well, the Fed said tariffs are going to create inflation in the summer, so they're going to wait to cut.
Right.
We recently wrote about this to our clients, and I think we shared some on Twitter. Tariffs are actually a tax because the money goes to the government. Like, so in other words, imagine if like the U.S. government said, I'm going to tax gasoline with an extra $6 tax.
Right.
And then CPI of gasoline jumps. The Fed's not going to raise rates because they'd be like, oh, people's wallets just got hit.
Right.
So we might actually cut because they're getting hit by paying this tax to the government. Because the government gets the money and it goes back in the economy. So it's not inflation. It's just transferring the money.
Huh.
That's what a tariff is, right? Like someone pays it, goes to the government, goes back in the economy. That's not inflation. It's actually like a tax.
Well, so Powell's argument and the Fed's argument would be that the companies will raise the prices of gas, which, although it could be offset by some of the revenue, that would technically still be inflation.
Well, see, so the thing is, that's like saying if the price increase takes place in a different part of the chain, it's inflation, but it's a tax later on.
Right.
Which we know mathematically, like transitive property is a tax is a tax is a tax. Like no matter where it is, it's a tax.
Right.
Like, do you know what I mean? Like it, because then all of a sudden, what is inflation then? Is it a pretend tax? Like,
or if it's an imaginary thing that pops up, or not even imaginary, but a real thing that pops up, but is offset in a later period of time, it ends up not being inflation. I mean, this is Trump's entire argument about, well, if we're going to lower taxes, people have the money to pay the higher gas prices.
Yeah. So I think if I wasn't partisan and I was just like doing this at Wharton undergrad, I'd argue it's not inflationary.
Got it.
Because, there's no inflation signal. Like if it's a one-time, it's not inflationary. And if it's really a tax, it's not. And I think anyone who says it is being locked into the CPI concept, but then they're missing the bigger picture. Because, like the CPI is not even a good measure of inflation. Like trueflation is better than CPI, for instance, right?
Do you think the way we calculate inflation, like the Bureau of Labor Statistics, the way we calculate JOLTS, like we got yesterday, 400,000 more jobs than expected, do you think these models are outdated in how they gather data?
Yeah, or they're a really imperfect representation of actually what's happening.
Right.
Because as you know, like the response rates matter. And there's like really weird CPI concepts. like how they treat how do you treat technological innovation? Because that's deflationary, but they never treat it that way. And with regard to like JOLTS, it rarely syncs up. JOLTS response rate's like 40%. But it doesn't sync up to other data like LinkUp or LinkedIn.
Well, it's really confusing, Tom, because I speak to a retail audience, and yesterday we saw the government says supposedly companies have 400,000 more jobs available. And then today, ADP payrolls say negative 33,000 versus 99,000 expected. And my audience is like, what the hell is going on?
Yeah. And actually, so if you kind of lift under the hood a little bit, so the JOLTS job openings really went up because restaurants didn't have a bunch of people show up.
Right.
So they're like, we put more wanted ads. But that's because of really deportation risks. People aren't coming to work.
Correct.
And then in today's ADP, the 3 categories that had negative jobs was financial services, professional services, and then education. Education is just summer, right? It's the seasonal. Professional services and financial, it's really probably Doge. I think consulting is down a lot. Remember McKinsey's, I think it was McKinsey cutting 10% of its workforce. I mean, government contracts and U.S. aid.
Right.
So it's not tariffs hitting the economy. It's Doge.
Do you think at all that AI was responsible for some of the services sector that got hit today?
It's possible. I mean, if it's less hiring, for sure. I mean, Salesforce today said half of their work is being done by AI. I mean, remarkable. Like saying half your work was done by like Zimbabwe or something, right? Like you've given out.
I mean, Meta says 30% of their code is being written by AI. Microsoft. I mean, like it is, and we'll get into that conversation, but it is kind of scary to think of a world where the most well-paid individuals in our society don't matter anymore in terms of software engineers. And so I think that will definitely have impacts on inflation. April 2nd, Liberation Day. This was a time where a lot of people were confused about what was going on. Liberation Day came out, the reciprocal tariffs came out, stock market fell to 2022 levels at 4,800. You were quoted as saying you didn't think Trump was going to violate a core covenant of capitalism. However, you did say, regardless, there's going to be a V-shaped rally coming. My question here is, why did your institutional clients not realize that the guy who was on The Apprentice was not actually going to tariff Zimbabwe by 90%?
Yeah. There were some wacky like we called it bananas, like numbers that were just bananas, right?
Yes.
Well, there's a couple of things. Institutional investors, they have to sit in guardrails. And like when the VIX goes up, they have to cut risk. And when the market has a drawdown, they have to cut risk. So basically, when the market falls and there's volatility, institutions can't hold on to much. So they're forced to sell. And so we would show them, the reason we said there's waterfall declines are V-shaped is that if you look at the last 100 years, as long as you don't generate a recession impulse, it's always V-shaped.
Right.
So that was our bet. It's like, this is a growth scare because high yield wasn't reacting, so it was just the stock market reacting.
Right.
Now, a second thing that got people super bared up, our institutions, was, Tom, the Fed's not coming to the rescue. They said, the only reason markets rally is the Fed cuts rates and unleashes money. And actually, our argument was, that's actually an illusion. So our belief was that you'd still get V-shaped even if the Fed didn't cut. But a lot of people were saying, look, the Fed said they're not going to cut.
Right.
So we're going to actually keep falling.
Right.
But instead we had the V-shaped recovery.
Why were you able to see that it is an illusion to think to depend on the Fed to bail you out?
Well, I think it is an illusion because when the Fed is adding liquidity, it's just giving the money to the banks.
Right.
So if the banks aren't lending, like that was happening like after 2008. They gave the money, the banks just built up reserves.
Right.
Like it wasn't sloshing around.
Correct.
So the more important money is actually retail. And that's there's 4 cohorts, 4 or 5 real distinct cohorts in the market today. So we know there's institutional.
Right.
There's non-US.
Yep.
Right. And
Foreign.
everyone's like, oh, we're leaving the US. There is high net worth.
Family offices.
Yeah, exactly. they stay bearish because they follow what hedge funds do.
Right.
Then there's corporates who do buybacks.
Correct.
And then there's retail. Retail was the only one buying the market at the April lows.
40 billion in March and April.
Yeah. I'm very proud of the retail investor.
Well, part of the reason they did is because they listened to you. So I guess the question here is, why do you think retail was able to see through? I mean, I know institutions have a fiduciary responsibility to sell, but why didn't they buy as heavy as retail?
I think it's because retail investors see this as a stock market. They're like, I like Palantir. I own Meta. Like, should Meta get killed because of tariffs? You know what I mean? Like, should Palantir get down to 80? Like, if you think about it, like, a retail investor sees it as stocks.
Right.
But the higher up you go, they're more macro. They're like, oh, Trump's going to just drive us off a cliff. You know, Fed's going to kill us. And so these actually create biases.
Right.
And then when the actual economy doesn't, or the stock market doesn't react to what their framework is, then they're like, oh, the market's insane. This is the dumbest rally. Only retail's buying. And so then they're caught off sides because they're now sitting on cash, institutions, on a complete full V-shaped recovery. And that's why it's the most hated V-shaped recovery.
Yeah, I mean, getting 4% in a money market while Meta's going up by 40%. How are these conversations? Because I imagine one of the reasons I was very bullish in 2023 is because you kept saying your institutional clients didn't believe in what was happening. And that was the wall of worry that you kept using to justify, no, we probably have more momentum left. When you talk with these people, do they just want to curse you out, but also at the same time, they want to say, well, thanks for letting us know it's time to buy?
Yeah. Well, compared to 2023 and 2020, the institutional universe is even more bearish.
Wow.
They're convinced we're late cycle. One thing to keep in mind is if you look at political affiliation in the equity market, 65% of fund managers voted for Biden.
I did not know that.
Yeah. So, but if you look at the bond market, it flips. The bond market historically votes Republican.
Correct.
So most people think Trump is a madman, right? Because they didn't vote for him.
Are you saying TDS is one of the reasons why people did not buy the dip?
Yeah, we write about it a lot in our research, actually. So it's a partisan stock market. And actually, people... So these have been uncomfortable conversations that we've had all year because...
I would imagine. No.
Yeah, because they're like, Tom, we can't... You're telling us not to sell. Because our advice was, you like, don't sell. Like, even though I didn't know where the bottom was, I did know it was V-shaped.
Right.
But they're like, Tom, we can't do that, you know? And then I was like, well, I showed the stat. Whenever the VIX is above 60 and then it closes below 30, 100% of the time it's been the bottom.
Correct.
And they're like, well, it's different because the Fed's not going to save you. So everyone found a reason to actually argue for why a recession was starting. And as you know, economists went full on recession call.
That's correct.
So if you're a equity guy, how can you go stocks are going to do V-shaped when the economist of the firm just said there's a recession? So I think they got caught, and we're not having happy conversations with people.
Do you still think this is so you've articulated now that this is the beginning of a new bull market, and I imagine those institutional clients lose their mind when you say that. In a sort of nutshell, why is that the case?
Well, it's fact based because we had a drawdown of more than 20%, and then we made a new high. So like the weird math that like let's say a commodity trading advisor, a CTA
right,
has is that when you have a drawdown and then you make a new high, that date is the start of a bull market.
Huh.
So actually, like in the mind of the institution now, breaking 61.41 was a new bull market.
Wow.
But the retail investor bought it at 4,800 to 61.41. But the algos are going to say a new bull market started like last week.
Do you think retail participation is net good?
Yes.
Why?
Well, there's a big transformation in the stock market today, and I actually would give credit to X, which is that the best companies have turned shareholders into customers.
Yeah.
Right. Like, I'll give you a perfect example. MicroStrategy. They've orange pilled people. Like, people own MicroStrategy not because it's a security business, but it's because Saylor is getting me more Bitcoin per share. Palantir. Alex Karp. is a cult of personality.
I know a little bit about that one.
Yeah.
You know?
How about Tesla? Tesla is, you know what? It's a bet on Elon. So these stocks are getting a real discount on their cost of capital because they've turned shareholders into customers. And so I think it's actually very healthy because that's the Peter Lynch thing. Peter Lynch is buy what you know. Well, someone says, like if you talk to someone who owns Tesla,
Yeah.
and you're like, tell us about, and they could tell you that Optimus Prime, FSD, literally they know the company cold. Like
Right.
they know what they're buying. Like the retail investor is pretty educated. So I think like when someone says, oh, it's dumb retail money, it's totally not true. I think retail knows what they're doing.
So a lot of the institutional guys will say, well, Tesla's at $1 trillion, PE of 200. That person that can tell you all the ins and outs of FSD doesn't understand valuation. But your argument here is, well, that person probably owns a Tesla. They have experience with FSD. They can be a little bit creative in terms of their imagination on where the company can go. And valuation might not matter as much. Is that the argument from the valuation side that says a 200 PE is crazy versus the cult member who says, I am in this car every day. You don't understand what you're talking about.
Well, let me put it this way. It's a very cogent question you're asking. But the real second question to that is, how many people fundamentally need the PE to be the basis for an investment? It's a shrinking universe, okay? Let me put it this way. Do you own a luxury watch?
I don't.
Okay. So let's say someone has or do you have any art or something, like a collectible?
Probably not, no.
Okay. Because remember, Tesla is scarce.
I have
right?
a Tesla, though.
Yeah.
Yeah.
But see, okay, I mean, Tesla is as scarce as art. Because name another company like Tesla. Like, there's electric car companies and robots, but in the world today, like go around the world, ask 8 billion people, is there another company like Tesla? We'll say, nope, there's only one Tesla.
Just one Tesla.
Okay, so that's a Da Vinci.
Wow.
Right? Think about that. It's like there's just one Tesla. And so then you say, pretend this is a Da Vinci, and someone will say, I'm only going to value this based on the value of the wood and the string and the paper. And so the PE of this is actually 12 cents. But then 100 people say, no, there's only one painting like this.
Right.
And I'm going to pay $100 million. That's the Tesla thing. Some people will say, oh, Tesla's a car company, but that's a small cohort. Everyone else says Tesla's a Da Vinci, right? There's no other company like Tesla in the world. So shouldn't that scarcity be worth a premium?
I have never thought of it like that, quite frankly. I mean, that is the first time I've even heard that as a comparison, but it makes a lot of sense because we know Elon's brand is superseding a lot of the brands. I mean, I don't even know who the CEO of Procter & Gamble is.
Correct. I mean, yeah, who's the CEO of the biggest company that's not a tech?
Right.
We can't even name them. And another thing you could say is that proves Tesla has a fixed supply.
Correct.
Of one. And when it's gone, there's no other Tesla. But they have superior manufacturing. Making a car is one of the hardest things in the world to do, and making electric, and they do it profitably.
Right.
And then look at Elon says, let's do something in space, and then he's 90% of the space business. And then he says, let's do some AI, and then Grok is valued at $130 billion. I mean, kind of he knows how to create businesses, and but there's only one Tesla in the world. Tesla company.
Right.
People might say it's a commodity, but I mean...
It's an argument that's hard to justify from that perspective outside of just using valuation. Is that why you said Tesla would lead the V-shape?
Yes. Yeah. So what we did, we created a list of what we call washed out stocks. And it's a simple exercise. We said, let's treat April 7th as the low.
Right.
Then comb through the 3,000 investable stocks that are liquid for our institutions. How many didn't make a new low on April 7th? So, and then on lower volume.
Right.
And it was 37 stocks.
Right.
But Tesla was one of them, Palantir. I mean, it was the list of basically what did it.
Correct.
Parabolic, yeah.
Oh.
NVIDIA was on that list. So it's kind of what's led the bounce. It's a simple thing. Basically, we were saying these were the first things that were already puked.
Right.
So then in April, people were already done selling, so they didn't make a new low. I mean, it's kind of logical, and that was our list.
And these were the one-of-one brands.
Yeah.
Hard to find in NVIDIA, Palantir, Tesla.
Yeah.
That's correct. Let's talk about what you introduced on Monday. So BitMine, you are now the chairman of the board, and you guys raised $250 million to buy Ethereum, effectively creating an Ethereum treasury. I guess the first question here is, why Ethereum?
Well, Ethereum, I'm sure the audience kind of knows Ethereum, but I like Ethereum because it's a programmable smart contract blockchain.
Right.
Okay. But that's a mouthful.
Yeah.
I would say the real reason I kind of would say I backed into Ethereum is that stable coins are really taking off.
Circle,
Yep.
$70 billion company.
Circle's like the best IPO in 5 years.
Correct.
And it trades at 100 times EBITDA. And it has made the performance. For some funds, it has made their year.
Wow.
It's what put people in the top 1%. So proof in the traditional Wall Street world, Circle is like God level stock.
Right.
And it's a stable coin. Stable coins are the ChatGPT of crypto because it's really crossed over into the mainstream. But it's really evidence that Wall Street is trying to equitize tokens.
Correct.
But then the crypto world is tokenizing equities because they tokenized $1, right? And then now you're seeing, JP Morgan wants their own stablecoin, Amazon, Walmart, Goldman. Well, stablecoins are a great business model and they work really well for consumers and merchants, but they all have to operate on a blockchain.
Correct.
And the majority of stablecoin transactions take place on Ethereum.
Mm.
So Ethereum's been like kind of out of favor. It peaked at close to 5,000 several years ago, and it was stuck at like 1,400, 1,500. It's back to like 2,400. But stablecoins are only 250 billion today.
Correct.
It's 30% of the gas fees on Ethereum, and Ethereum mints more than 50% of all stablecoin creations. Treasury Secretary Scott,
he loves them.
Yep, and he says he thinks it's a $2 trillion market, which is 10x increase. The U.S. government wants more stablecoins because stablecoins collectively are the 12th largest holder of treasuries.
Correct.
And they're creating a lot of dollarization. 80% of stablecoin usage is outside the U.S.
Right.
So, but a 10 times increase in stablecoin creations is an exponential growth in gas fees for Ethereum. So I think Ethereum is a very direct beneficiary of Wall Street trying to equitize crypto.
Correct.
And crypto tokenizing equity. It literally sits in the middle. And so I think that's why Ethereum, I think, is going to be rediscovered this year. And then, of course, we're seeing it now because Robinhood is...
They just announced using a layer 2 on Ethereum to be able to tokenize equities.
Correct.
Okay, so you got companies like Robinhood that are tokenizing Wall Street. You got the administration that's very supportive of stablecoins because it will be creating more demand for treasuries. But then you have an asset that is what the stablecoin is running on, the ChatGPT moment of crypto, but its price has lagged fundamentally in comparison to Bitcoin. Why do you think people aren't getting that story?
Well, because I think, crypto is a narrative-driven space, okay? Because it really runs on trust. Right. And so we know Bitcoin, the thesis is trust and, digital gold. But I think the story now is programmable money. And so maybe what you're seeing is people are discovering that you not only want programmable money, but you want to be running on the biggest network that does programmable money. And Ethereum is 300 billion. So it is the largest smart contract blockchain. So right. I think that's why Ethereum has the opportunity to really transform. Yeah.
And back in 2021, the only use case for Ethereum were NFTs and like the blockchain for smart contracts NFTs. That has kind of died out. This seems to be a much more durable use case that has the government supporting it, which makes it more logical here. BMNR stock was 4. It's at 40 now. I mean, I think we can call that the Tom Lee effect. I think people trust in your vision. Do you simply believe that this asset will give you a better risk reward versus just buying Ethereum?
Well, I won't necessarily speak to BMNR specifically, but I can speak to why Treasury companies, which is what BMNR is, makes sense. Because someone's going to say, oh, well, if I want to bet on Ethereum, why don't I just buy the ETF? Right. Or why don't I just buy it on chain and
custody yourself?
Custody, right? Yeah. But see, a Treasury company has 5 real important pieces of optionality. Okay. So if you buy an ETF or if you buy Ethereum on chain, your units held of Ethereum is going to be constant, right? I mean, if you buy an ETF, you have a contractual amount of Ethereum you
Correct.
have. And it maybe shrinks because they charge you fees. But these treasury companies, their goal is to grow the token held per share.
Right.
MicroStrategy, that's their benchmark, key performance metric. So one, if it trades at a premium to NAV, net asset value, they can issue stock and create more net asset value per share.
Right.
That's actually what they call reflexive growth. I don't think there's very few things in the equity world that are reflexive that way. Number two, because the underlying token is quite volatile, in fact, Ethereum has twice the delivered volatility of Bitcoin.
Correct.
If you held Ethereum an ETF, and you said, I want to leverage it and buy more Ethereum ETFs by borrowing money, the bank's going to charge you 10%. But if you're a treasury asset company, one, you're a corporation, so your cost of money is cheaper. But two, you can sell the volatility in the form of convertible or derivative, and then your cost of capital in MicroStrategy's case is zero.
Right.
So you got 2 levers to pull. The third lever you're pulling is that you have a market price to NAV, and then you have an equity, and then there's other treasury companies outside, price to net asset value.
Correct.
And so if something's trading at NAV, price net asset value, and you're trading at 3 times, you could do mergers and buy other treasury companies. So there's this arb that way. The fourth is you can create an operating company. Hey, let's create a business that helps the DeFi ecosystem.
Can lend out ETH, stake ETH.
Staking, yeah. Correct. And that you don't really do in Bitcoin, but actually on Ethereum, that's a huge benefit.
Yeah.
And then the fifth is you have you create what I call a structural put. Okay. So an example is MicroStrategy has 600,000 Bitcoin.
Yep.
If the US government wants to get to 1 million Bitcoin, or Qatar, or UAE, or I don't know, UK, okay, and they say, I'm going to buy 1 million Bitcoin in the open market, the UK buying 1 million Bitcoin, or the US buying, or China, Bitcoin's going $1 million, right? Whereas someone says, I can buy the US government might say, MicroStrategy has 600,000 of this already.
Yeah.
I'll pay 200% premium, and it was cheaper than paying $1 million per Bitcoin. So that's called a sovereign put.
Right.
Well, guess what? In the Ethereum world, because it's a staked token, if one of these treasury asset companies gets to 5% of ETH, they are hugely important to the ETH ecosystem.
100%. Yeah.
So then their multiple should go up. Because, Goldman Sachs, for instance, if they do a Goldman dollar and it runs on Ethereum, they want to make sure the Ethereum network is secured. So eventually they're going to be buying a lot of Ethereum.
Right.
But then the staked entity already has it. So maybe they'll just buy the staked entity.
Right.
So the staked entity has a Wall Street put.
Right. It's a very logical way to think of, if you believe in that overarching thesis around Ethereum, then are there levers you can pull to keep it alive? All right, Tom, thank you again for taking the time today. I want to do some rapid fire just so people get to know a little bit more about Tom. What is your favorite movie?
Oh, okay. I hope you don't think these are a little dark. Okay. But 2 movies that I enjoy watching a lot are The Apartment, which is Jack Lemmon, 1960s. Shirley MacLaine. I don't know. It's such a good movie. It's a little sad, but it's a great movie. And I love Lost in Translation.
I love that one too.
Yeah.
I love it.
Which, but I think that's the movie where I realized, Bill Murray is genius. Because I totally believe that he was actually that person. It's not him as an actor.
Right.
So.
What is your day-to-day like? When do you wake up and when do you sleep, and what is happening during the day?
Okay. The last couple weeks is not a good snapshot, but because last night I was in the office until almost 2, maybe 1 a.m. I got home at 2.
In meetings?
Yes, I've been in Zoom. I'm usually fully booked all day and on Zooms. And then I got up at 5:30 a.m. for CNBC. And as soon as I got to the office today, I've been in Zooms all day. Wow. So I think I'm heavily scheduled. But I do find time to comment on Twitter, especially all the haters.
And you do your own tweets, right?
Yes.
I mean, it looks like you do your own tweets.
I do. That's why
it keeps it authentic. Yeah.
Yeah, actually, so this is really important. I have plenty of people that offer to write things for me or research or the tweets, but I was like, you know what? I don't want someone to think that came from me.
Correct.
It has to come from me. So even our research, like I create a video every day for our clients.
Right.
It's about a 10-minute video, 5-minute video, and I do that, and I think it's important that I'm speaking to people directly. So research is a lot of work. I mean, that's why my hours are crazy. But of course, I have to talk to a lot of people, and we have to do a lot of research. And we're doing research by calling people and getting information. So, it's a busy schedule.
Do you enjoy and love that grind?
Yes, it doesn't feel like a job.
Which is a blessing.
Yeah, and I've been doing this for 34 years, and it's actually never felt like a job.
Mm. Do you feel like a rock star?
No, I do not. But if I had a posse, I certainly, or like a limo or security, then I would know what it's like to be a rock star.
What's your favorite city outside of New York that you travel to?
Well, my wife's from Los Angeles, so we spend a lot of time there, and I really realize it's great. It's like the weather is amazing and the food's great. But if someone said like, what's my favorite country to vacation in? It's actually Mexico. Like I like Cabo a lot, and I like Mayacoba. I mean, and yeah, so it's great.
Granny Shots, your ETF just got $1 billion AUM. Congrats on that.
Almost 1.5 billion actually.
Wow. Well, no, you should be correcting me on that. 1.5 billion is not easy to raise. Two companies that my audience particularly care about that are in Granny Shots. Just any quick thoughts on them? Start with Palantir. Any thoughts on that one?
Yeah, I mean, Palantir to me is reinventing what it means for a company to have a relationship with a corporation to make them a better business. Usually that's like a consultant,
right,
or a tech company.
Right.
Palantir is both with few people. It's almost like they're getting a wizard. Palantir is like the wizard of the Fortune 500. Well, of course, the government, but look at the role they played in a lot of things that are look like magic. That's Palantir.
4,000 employees, less than 800 customers. Pretty incredible, doing about $4 billion in revenue. Second one that just became the largest holding of Granny Shots, Robinhood. Any thoughts on this one?
Yeah, I mean, Robinhood's amazing. I think it's the Morgan Stanley of this young generation. What people forget is in the 1980s, Wall Street was, this old boys network, and a few brokers were starting up for the baby boomers.
Right.
Baby boomers were in their 20s then.
Yeah.
And Charles Schwab was a newsletter.
Yeah.
And then he's like, well, I'll become a broker. So the brokers of the boomers, which was like E-Trade and Schwab, well, that is Robinhood today.
Yep.
So I think that Robinhood is incredibly smart. They're crypto. They have a UI that is amazing. They understand how important that is. And then they're making really smart moves. So yeah, that's why it is a granny shot.
I love it. Tom Lee, thank you for everything you do. Thank you for being the voice of retail, and thank you for the time.
Great. Thanks.
You crushed it.